If you are thinking of becoming a day trader, before you decide to become a day trader, you first need to understand that it is not one single market. A person trading currencies is not dealing with the same market as someone trading a company's stock. A gold trader is not watching the same information as a Bitcoin trader. They may all use charts, but the reasons behind the price movements can be completely different. So before looking for a strategy, you first understand the different financial markets and decide which one fits you. A financial market is simply a system where people and companies or banks, governments or institutions buy and sell financial assets. In economics, financial markets are sometimes divided into money and capital markets. Money market mainly deal with short-term debt. Capital market mainly deal with the stock and long-term debt such as bonds. But as a day trader, you will normally choose your markets based on the assets you want to trade. There is one important thing you need to understand. What you trade and how you trade it are not always the same thing. Gold is a commodity, but you can trade gold through futures like an ETF or a CFD. The Nasdaq is an index, but you can buy the index itself. You normally trade a financial product that follows its price. Understanding the difference will save you from a lot of confusion. So, number one, Forex Market. Forex means foreign exchange. This is the market where one currency is exchanged for another currency, and that's why currencies are traded in pairs. For example, we have the Euro USD compares the Euro with the US dollar, the GBP JPY, which compares the British pound with the Japanese yen. When you buy a currency pair, you are buying the first currency and selling the second one. When you sell the pair, you are selling the first currency and buying the second one. Forex prices are mainly influenced by the interest rates, inflation, economic growth, employment reports, political events, central banks, and the general confusion of people in the country's economy. Forex is also a very large global market. According to the Bank of International Settlement, the global foreign exchange trading research reached approximately 9.6 trillion per day in April 2026. Forex may fit your studying countries, banks, interest rates, and global economic news. But remember that Forex brokers normally offer leverage. A leverage allows you to control a large position with less money. That can increase your profit, but it can also increase your loss very quickly. Number two, the stock market. The stock market is where people buy and sell the ownership of companies. When you buy a share of a company, you own a very small part of the company. For example, when you buy an Apple stock, you are buying the ownership of Apple. And when you buy a Tesla stock, you are buying the ownership in Tesla. The stock prices can move because the company's earnings or new products, management decisions, government regulations, like anything, economic news, information about the industry. A stock trader needs to understand that every company is different. Good news for a company may be bad news for another company. Even when the general market is rising, an individual stock can still fall because something wrong with that specific company. The stock market may fit you if you enjoy following business, technology, earning reports, and company news. However, not every stock is good for day trading. Some stocks have high trading volume and move regularly. Others have a very few buyers and sellers, which can make entering and leaving the trade more difficult. So number three, we have the bond market. Bond market is one of the most important financial markets, even though many beginners will ignore it. A bond is basically a loan. When a government or a company issues bonds, it is borrowing money from investors. The investor provides the money and the borrower promises to repay according to the conditions of the bond. You can think of a bond as a professional IOU. A bond prices are strongly connected to the interest rates. When interest rates changes, the bond prices yields can also change. It is very important because the bond market affects forex, stocks, gold, and many other markets. For example, when the government bond yields increases, the investors may move money away from certain stocks or assets. Changes in a bond yields can also strengthen or weaken a currency. Most beginner retail traders don't directly trade or day trade individual bonds, but every serious trader should understand that the bond market because it helps explain why large investors where they are moving money. Number four, the commodity market. Commodities are physical goods, the natural resources, which include gold, silver, oil, natural gas, wheat, coffee, corn, many other products. And then commodities are usually divided into two groups. We have the hard commodities, which are normally natural resources such as gold and oil, and we have the soft commodities, which are normally agricultural products such as coffee, wheat, and sugar. Commodity prices are affected by supply and demand. For example, oil can rise when supply becomes limited. The agricultural products can move because of weather conditions. Gold can move because inflation and interest rates fear strengthen, like the strength of the US dollar and the global uncertainty. As a retail trader, you're normally not buying physical barrels of oil or carrying gold bars at home. No, you are usually trading a product that follows the price of that commodity. That product may be a future contract like an ETF or a CFD. The company may make profit or you may enjoy the decision of the global supply decision, whether the economies or the condition. Number 5, the index market. The market index measures the performance of a group of assets. For example, the S&P 500 stock, a large group of major American companies like the Nasdaq 100, mainly stock of large non-financial companies listed on the Nasdaq 100. An index helps you understand how large part of the market is performing, but you cannot directly buy or sell an index. You normally trade a product connected to that index, such as an ETF or a future contract, or whether largely available as a CFD. This is an important difference. The Nasdaq 100 is an index. The NQ is a future contract based on that index. The QQQ, like 3 Qs, is the ETF designed for that index. The Nasdaq CFD is an agreement provided by the broker to follow a movement of that index. These products may follow the same market, but they don't need to have the exact same rules, contract, costs, risk, or the trading cost. Index trading may fit you if you prefer trading greater directions or economies instead of analyzing the individual company. Number 6 is the derivatives market. The word derivative means difficult but made simple. A derivative is a financial contract whose value comes from something else. That something else is called the underlying asset. The underlying asset could be gold, oil, a stock, or an interest rate or an index. Futures, options, and swaps are examples of derivatives. A future contract is an agreement to buy or sell something that at an agreed price under a specific contract and condition. An option gives the buyer a right to connect to buying and selling that asset, but not always obligated to do so. A CFD is an agreement between a trader and a broker to exchange difference between opening and closing prices. A CFD are not available or regulated in the same way in every country. Derivatives can provide leverage and access to many markets, but they can also be complex and very risky. The CFTC warns that the futures and options trading can lead to loss of money, and that situation even the amount originally invested. Don't trade a derivative only because you saw people making money from it. First, we have to understand the contract size, the leverage, the expiry date, the margin requirements, fees, and the processing fees. Number 7, we have the almighty cryptocurrency market. Cryptocurrency includes the digital assets like Bitcoin, Ethereum, and other tokens. A crypto market is created and issued or transferred using the blockchain or similar technologies. Crypto is different from the traditional currency. A currency such as US dollars is issued and supported by the central bank of the government. Bitcoin is not issued by one central bank. Its price is mainly depends on supply, demand, adoption, regulation, market confidence, and the speculations. Crypto market can also move very quickly. The prices rise and fall heavily within a short period of time. Many crypto products trade continuously, including during the nights, the weekends, every time. They may give you more opportunities, but it can also make it difficult to step away from the market. You can trade the crypto through futures, options, or perpetual contracts and other derivatives. The crypto market may fit you if you understand the technology and can manage high volatility, but don't choose it only because it moves fast, please. First, the movement creates thinking that fast movement creates fast profit can also create fast losses. So how should you choose the market? Don't choose the market simply because another trader is making money from it. Choose according to your own situation. First, look at your schedule. If you are a student, or maybe let's say you have a 9 to 5, choose a market that is actively available when you are available. Second, look at what you enjoy studying. If you enjoy like companies and buying new like business news, stocks, or anything that fits you. If you enjoy economies, central banks, currencies, Forex may fit you. If you enjoy global supply, commodities may fit you. If you prefer like the general direction of the stock market, indices may fit you. And if you enjoy technology, managing high volatility, that means that crypto may fit you. Third, look at the risk tolerance. Some markets move slow, others can move very quickly. The faster movement doesn't automatically mean the better market. It only means that profits and losses can happen first. Finally, choose one market and study it properly. Don't trade Forex, crypto tomorrow, gold the next week, next day, or stock after without understanding any of them deeply. Every market has its own behavior, and every market has its own important news. Every market has its own risks. So the conclusion is this: before becoming a day trader, understand that you have different markets to choose from. There is Forex market, there is the stock market, there is the bond market, commodity market, the index market, derivative market, cryptocurrency market, and all of those. You don't need to trade all of them. You only need to find one that fits your schedule, your interests, your capital, and your personality. Then study how it moves, understand what influences its prices, understand the product you are using to trade it, and understand the amount of risk you are taking. Don't begin by asking which market can make me rich faster. Begin by asking which market can I understand deep enough to trade with discipline, because the best market is not always the one that moves fast. The best market is the one you understand well enough to manage the risk and follow the trading plan.